Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're looking at a few stay-at-home style stocks to see if investors should consider buying a few of those amid the coronavirus market sell-off, which just seemingly continues to get worse. But before we do that, I want to say, remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com. Also, make sure to subscribe and leave a review wherever you listen to your podcasts. And make sure to also check out our new Zacks.com/promo page for a look into some of our services, portfolios, and more. So we're going to start with a quick market summary. Since Monday has been pretty crazy so far, U.S. stocks fell hard enough to trigger a halt to trading in the morning. This came amid a price war for oil and the continued spread of the coronavirus around the world. So the Dow and the S&P 500 both fell 7% at the open. The drop then triggered a trading halt for about 15 minutes. And then all three major U.S. indexes tried to recover. But as of 11 a.m. Eastern, things were still pretty bad. So the Dow Jones was down about 6.7% as of 11 a.m. Eastern, and the S&P was down about 6.5%, and the NASDAQ was down 6%. So over the weekend, Saudi Arabia started a further price war on oil as it continues to clash with Russia. This sent oil prices down by the most in one day since the Gulf War in January of 1991. Oil prices fell by more than 20%. The 10-year U.S. Treasury note dipped below 0.4%, which is a new historic low as those yields just continue to go lower and lower. We also saw the yield on the 30-year Treasury note slip below 1%, reaching about 0.86%. And then on the coronavirus front, this is mostly coronavirus and oil-based as well. So on the coronavirus front, the total number of confirmed cases has topped 110,000, with over 3,800 global fatalities. There are now more than 29,000 cases outside of mainland China versus about 10,000 just a week ago. And the U.S. tally rose to about over 550 with about 21 deaths. With that said, we are clearly still in the early days of it in the United States, so things could continue to get, and I would say, are likely to get worse in the U.S. We so far have 8 American states, including New York, who have declared a state of emergency as infections spread throughout new parts of the U.S. Italy has now quarantined some nearly 20 million people, as Italy and South Korea remain the two largest hit countries outside of China. And as I mentioned, things are likely to get worse as more cases pop up in the U.S., but actions are being taken. U.S. lawmakers passed last week an $8 billion emergency spending package. The Fed cut its benchmark interest rate by a half percentage point, and it's likely to cut again at its next meeting. But still, the volatility remains. The sell-off seems to be getting a little worse, as you still have companies like Apple who are trading where they were at about early December, so things could maybe fall even further. And we won't really know more, I would say, until companies start reporting their first quarter results and we see some guidance based on what the coronavirus actually is doing to companies. We know that Apple and Microsoft and MasterCard and some other companies have already said they're expected to miss their Q1 revenue guidance based on all the setbacks in China. So we'll know more in the next few weeks in terms of those companies that are slowly going to start reporting their first quarter earnings results. But on the positive side, we should note that some major Chinese cities, which includes Shanghai and Beijing, have started to see people returning to work in slowly normal business activity, and life is gradually starting to resume there. On Monday, the Shanghai government said that major tourist spots and sports facilities had reopened after being closed for more than a month. So that's a positive side, seeing as that China was the epicenter for the start of all this. Disney even noted that Shanghai Disney Resort said it would partially resume operations as a first step in slowly reopening some of their business over there. And obviously, it's not just going to quickly go back to normal, but it's a positive sign that China is trying to get back to functioning more normally after shutting so much down over the last month plus based on trying to prevent the spread of the coronavirus, which is now, as we know, throughout much of the world, and as cases start to pop up more and more in the U.S. And with that said, as more cases start to pop up in the U.S. and elsewhere, more and more people are likely to decide to work from home or will be slowly forced to work from home if they can. And so today we're going to look at a few stay-at-home style stocks that investors might want to consider buying at the moment. And obviously, it can't be said enough that the market sell-off could continue. The volatility is likely to remain. So don't just try to buy the dip because the market dropped 7% again on Monday, because finding a bottom is really most often only found in retrospect. So if you buy on the dip, it could continue to go lower. And obviously that's a risk that anyone who's buying now has to be willing to take at the moment. So with that said, we're going to start by taking a look at Zoom Video Communications. That trades under the ticker ZM. So far, the stock is up about 85% in 2020. And it was up about 85% in 2020. It's still up at around 60% so far this year. It's fallen down a little bit over the last several days. But before we get into more of the price movement and all of that, we're going to give the basic business pitch for Zoom Video Communications. So, as their name suggests, the business is pretty heavily focused on video communications. The Zoom Video's cloud-native platform allows people to connect via video, voice, chat, and content sharing. In their main pitch, the biggest thing you need to know is that their tagline is basically that they boast that, quote, thousands of people in a single meeting. It can put together thousands of people in a single meeting across disparate devices and locations. So Zoom's video offerings really seem to work perfectly in today's globally connected business world. The teleconferencing firm allows people to meet face-to-face across the world, across the country, across the city, and it's really positioned well in our more modern work from home, work remotely type environment. And then also on a bigger scale, Zoom Video could easily benefit from the longer term shift as more and more international corporate giants are maybe put under more pressure to try to reduce some of their carbon footprints so they don't have big flights across the country or internationally or all of that. So being able to meet via video conference might become more and more practical. And in fact, we should note that ZM does see this as some part of their business pitch, at least. So in February, they released a list of their top 10 companies in what they called their green leader customers, who were, quote, estimated to be avoiding the most carbon dioxide emissions by replacing face-to-face in-person meetings with face-to-face Zoom video meetings. And even those who aren't necessarily worried about the potential environmental impact of these flights and these big companies who are flying over the world at all times and on private jets, you might maybe not worried about that at all. But if you aren't worried about that, maybe you're worried about businesses saving money in any way they can. So these private jets and flying all around the world might be a way, or stop flying all around the world might be a way to cut any sort of non-essential business flights. And that's already sort of how a lot of the corporate world is trending. There's less budgets for flying today than there used to be. So especially as it's just way easier to communicate with people on a daily basis. And Zoom Video is certainly a business that's poised to be a bigger role in our sort of modern work remotely and video communication, online, everything, mobile society. And so last week, we should note the big reason why we're talking about the company today is last week. So last Wednesday, Zoom Video's fourth quarter fiscal 2020 financial results really wowed Wall Street. The company's Q4 revenue was up 78%, and their overall sales were up 88% for the year to about $623 million. And their adjusted quarterly earnings of 15 cents per share blew by our estimate of 8 cents per share. The company is now blown away our average bottom line estimate by over 340% in the trailing 3 quarters. We should also note that their full year operating cash flow surged nearly 200%, And Wall Street was also, and this is a big thing to pay attention to, they were also happy to see that the company continues to add larger clients. So the company closed the year with 82,000 customers with more than 10 employees. So it's still focused on very small businesses at the moment, which was up 61% from the year ago. And they also boasted that they had about 650 customers who contributed more than $100,000 in trailing 12-month revenue, which was up about 90%. So they're starting to get companies who are making more money and are larger. So that's a good sign for the company going forward. So then looking ahead, Zoom Video expects its full year fiscal 2021, which is its current year, their revenue will be between $905 million to $915 million. And this crushed our pre-earnings release estimates of about $855 million. And investors should note that on the high end, their estimate represents growth of about 48% compared to 2020. And then at the bottom end, Zoom Video also called for their adjusted fiscal 2021 earnings per share to hit between 42 to 45 cents per share. This also easily blew by our pre-release estimate of about 27 cents per share and would mark about 30% growth on the high side. And then on the coronavirus front itself, we are going to quickly note two analyst notes about why this coronavirus could be positive for Zoom Video. So in a note to clients in late February, Bernstein analyst Zane Crane said that, quote, in the last 30 days alone, average daily downloads are up 90% versus the prior 30-day period. And then more recently, a Stifel analyst noted that the global coronavirus epidemic will undoubtedly drive awareness and adoption of the company's video conferencing platforms, and we expect this environment to further enable the company to post industry-leading growth rates. So in the end, Zoom Video really does appear to be worth considering, not only to bolster your portfolio maybe amid this coronavirus market volatility, but also as perhaps a long-term bet on the future of our digital and interconnected and work remotely world. And then obviously, as I mentioned, I want to just continue to mention it. The market is pretty crazy right now, so the risk remains pretty high. But just to give people perspective of where the stock is at the moment, last Thursday, Zoom, which was the day after it reported, Zoom stock climbed 7% and closed regular trading at $125 per share. It's touched as high as $129 per share and is currently trading at about $113 per share. And if we look back, the company went public in April of 2019, so about a year ago, and it saw early success. Overall, the stock is up 80% since its debut, and this has crushed its industry's now small decline at this point, and it stands in direct contrast to Uber and Lyft and some other companies who also went public around that time last year. So Zoom Video is definitely a stock worth considering now and maybe in the future as a longer term bet on the future of this work remotely and work from home and interconnected digital world, as I mentioned now ad nauseum. And we're going to move on to another company that's much more well known than Zoom Video, and that is Netflix. Their shares have surged over 40% since late September. They started to climb right near their 52-week highs. The stock has been up around 17% in 2020, and it did, like a lot of other stocks, it's fallen over the last week or so. But with that said, Netflix has easily outpaced its FAANG peers so far this year. This includes Apple, Amazon, Google, Facebook, and also throw in Microsoft in there as well. So Netflix is up about 17%, while Facebook is down 15% this year. Google's down 7%. Apple is down over 6% so far in 2020. So Netflix is certainly a stock that had been underperforming those peers, but now over the last several months and in 2020, it's been an outlier in those FAANG stocks. And Netflix, as Zoom, has sort of an almost perfect business model for the current coronavirus worries, because it's tailor-made for people who are staying at home. Obviously, it doesn't have really any supply chain issues that it's facing. Its streaming TV product is perfect for people who are either choosing or being forced to work remotely. In Netflix has a presence throughout most of the world now at this point. The only market they're not in that of any significance at all is China, and that's for different reasons why they're not in China. But so they're all over the world, and people all over the world are currently being more likely to stay home, and this could continue to get worse over the next several weeks or several months. We don't really know at this point. But in general, obviously, Wall Street investors have been a little worried that Disney, Comcast, Apple, AT&T are going to hurt Netflix long-term growth prospects. But despite all of that, Netflix did beat its own fourth quarter subscriber estimates, and it's still by far the largest streaming TV company in the world. It has about 167 million global users and counting. And obviously, Netflix does face real competition from Disney Plus and others, but overall, the cord-cutting revolution is really just getting started. So there's just going to be a bigger piece of that streaming pie, and Netflix is certainly going to get their share of that as well. So on the cord-cutting note, we should note that roughly 56 million households will reportedly have canceled cable or satellite TV subscription by 2023, and this is according to eMarketer. And this stands to benefit the companies like Netflix and Roku and other streaming-focused firms. And looking ahead, Netflix adjusted 2020 earnings are expected to climb 47% this year based on our Zacks estimates. Meanwhile, its fiscal 2020 revenues are projected to climb about 21% to $24.4 billion. The company is currently a Zacks rank number 2 buy based on some positive earnings estimate revision activity, and it certainly might be worth considering at the moment, seeing that it had been underperforming recently, but their business model seems pretty immune overall to these stay-at-home virus worries as the coronavirus continues to spread throughout the U.S. Investors might also want to take a look at Slack, which trades under the ticker WORK, as a company that might be sort of immune to the stay-at-home worries of the coronavirus, because its business is directly related to people working remotely. So you can consider Zoom, which we talked about today, Netflix. Slack is a stock you might want to consider, even though it's a little more shaky in terms of its longer-term business model, in my opinion, because it faces a lot of competition from big-name companies such as Microsoft and Google. But certainly those three companies, in more than anything, Zoom and Netflix might be worth considering. But obviously there's all of these broader worries that these companies might not be able to escape amid this broader market sell-off. So overall, the market seems hard to gauge, but certainly consider Netflix and Zoom at the moment. And that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.